Let's take some time to go through some exercises at the end of the chapter. Specifically, let's look at exercise 7.1 and kind of talk through some of the problems here. Number 1 on exercise 7.1, which of the following would be least likely to be classified as a city's general capital assets? Well, let's think about that. Roads and bridges? No, that's big infrastructure. Electric utility lines? Computers used by the police department? Well, we know that the police department is generally reported in the general fund, so those computers would be typically general capital assets. Computers used by the department that collects the city sales tax, which is dedicated to debt service on general obligation bonds. Well, that sounds like another governmental fund. That would definitely be a governmental activity that is commonplace that would be handled through a governmental fund. So the answer here really would be the electric utility lines, because those electric utility lines are typically handled through an enterprise fund. It's acting as a business, providing services and receiving money for those services. The next one we've got, number 2, is a city should not report on its general fund balance sheet an office building constructed over 100 years ago. Now, why wouldn't we do this? Would we not do this because A, the building would likely be fully depreciated? Would it be B, it would be too difficult to determine the historical cost of the building as measured in current dollars? What does that mean? C, the measurement focus of the general fund is on current financial resources, and the building is not a current financial resource. Or would it be the building would be considered an infrastructure asset, and infrastructure assets are excluded from governmental funds? Well, we know that's not an infrastructure asset. A building is a building is a building. The reason that this would not be in a general fund is this building was purchased over 100 years ago and is really not focused on current financial resources. It's not a current financial resource. It's been around for a long time. That's why it wouldn't be in the general fund. Next, which of the following costs should not be capitalized and reported on a city's government-wide statement of net assets? Would that be A, payments to a city artist to design a new city logo? B, computer software that a city purchased from outsiders? C, paintings acquired for display in the city's art museum? Or D, legal fees incurred in acquiring land to be used for a city park? Well, payments to a city artist to design a new city logo wouldn't be capitalized and put in the government-wide statements, because typically that's going to be a service provided by an outsider in developing a logo. So that's going to be probably either a contract worker providing that, but those would be in outside service. Computer software, that would be capitalized. Paintings would be capitalized, and legal fees are all those costs that are incurred in assets. Number 4, which of the following collectibles need not be capitalized and reported on a city's government-wide statement of net assets? Now, we didn't go over this in the lecture because there are so many aspects to this course, and I'm just trying to highlight the main focus, but the answer to this would be the early 20th century Impressionist painting, and purchased for its permanent collection. That is not necessary to be capitalized. Number 5, per Gaspy Statement 34, roads and bridges should be capitalized and reported as assets on A, both a government-wide statement of net assets and a general fund balance sheet. B, neither a government-wide statement of net assets nor a general fund balance sheet. C, a government-wide statement of net assets but not a general fund balance sheet. Or D, a general fund balance sheet, but not a government-wide statement of net assets. So basically, in this particular example with GASB, with roads and bridges, a government-wide statement of net assets would be where this infrastructure would be capitalized, but it would not be capitalized under a general fund balance sheet. Now we'll move on to number 6 here. Which of the following conditions does a government not have to satisfy to use the modified approach to reporting infrastructure assets? Is it must assess the condition of its infrastructure at least once every 3 years? B, it must estimate the annual amount necessary to preserve the assets at a specified condition level. C, it must document that the assets are being preserved at or above the specified condition level. Or is it must use the modified approach for all of its infrastructure assets? Well, it states here, which of the following conditions does a government not have to satisfy the modified approach? It's basically the D. It uses the modified approach for all of its infrastructure assets. And then as we move on, per the modified approach, a government need not capitalize infrastructure, depreciate infrastructure. Well, that's the answer. It's not required to depreciate the infrastructure. A government constructed a bridge 20 years ago but doesn't have reliable records of the cost. However, the cost to construct a comparable bridge today would be $30 million. A bridge construction index has a value today of 200 and a value of 20 years ago of 80. The bridge has a useful life of 60 years, and so as a result, the government should record the bridge with $8 million. Now, how are we calculating that net of depreciation? Based on the index and based on the useful life, we come up with the 8 million figure. Number 9, recognizing the difficulty of implementing GASB 34 related to retroactive capitalization of general infrastructure, GASB has A, exempted small governments having to apply them. Again, that's not a specific area we're going to focus on. When we deal with number 10, GASB's deferred maintenance costs really don't need to be explicitly measured or reported when we're dealing with depreciating capital assets. And then the last one here was C. A city would probably not have to recognize an impairment loss on its hospital building if A, it was severely damaged in a fire. C, it would be likely be used to serve far fewer patients than expected. Its market value declined significantly, or it will be transformed into a warehouse. Well, the impairment loss wouldn't have to be recognized if its market value declines significantly, because again, this is being recorded at historical cost. The market value really doesn't matter to us. It would need to show an impairment if there's a damage in the fire or other issues such as being transformed into another purpose.